How do you diversify a portfolio? What does that actually mean? And why is it done? In today's video, I'm going to be going over all these questions and how you can maximize the potential of your money to make it really work. Diversifying may sound somewhat intimidating if you're new to investing, but it really could not be more simple. Diversifying a portfolio is a management strategy that most investors use to reduce risk, increase overall exposure, and minimize the volatility of their stocks. It's essentially a safety net put in place to hedge against certain sector downturns. You can think of diversifying a portfolio as putting your eggs into many baskets, therefore increasing your exposure to certain sector upturns as well. It's important to note that there is no one correct method to diversifying a portfolio, and opinions and asset allocation will vary greatly between person to person. Considerations such as a person's time horizon, their financial goals, their risk tolerance, and their available assets will all play into how they will want to diversify their portfolio. I'll be analyzing two different layers to diversification, the first being at a broad macro scale based on security type, and the second being a more zoomed in micro approach of how to diversify within each security type. I'll first begin at the broad level, allocating your assets between two main types of securities: debt security and equity securities. A security is simply any tradable financial asset. Companies or trusts issue out securities in order to gain their own capital that they can then go off and use to invest in other things. So let's start with equity securities. Equity security is essentially common stock that shareholders receive when they buy into a publicly traded company. When I buy, let's say, Apple stock, I am purchasing an equity security and becoming a shareholder, owning a percentage of the issuer corporation, that being Apple. So you can think of yourself as a small owner in the company. If the company is doing well, its valuation or worth increases, and this increases the price of each stock or portion of the company. And the owners of the company, the shareholders, gain money on their initial investments. If the company does poorly, the stock loses valuation and is worth less. The share price then decreases, and the shareholders lose money. If that company goes bankrupt, you lose all your money you've allocated into that company. They really don't care about you, the common shareholder. So essentially, when buying equity securities, there is no guarantee return on investment. You may lose everything, you may make a lot, you may make a little. There really is no guarantee. It's more of the betting, per se, side of investments. There is always risk associated with equity securities, as the return is based on the performance of the issuer. Okay, so we have a little idea of equity securities. Let's move on to debt securities. Debt securities can be referred to as fixed income and are distributed in terms of bonds, bills, and notes. Issuing a debt security is again a way for an investor to raise capital that they can then go off and use to invest in other things and hopefully make money on that. You yourself have likely been issued debt securities for the sole purpose of you raising your own personal capital. When you go to buy a mortgage or a car, you take out a loan from a bank. They're issuing you a debt security. They are the issuer. You are receiving that money. However, there is the pre-agreement that you are eventually going to pay them back that money, that principal, with an extra interest on top of it. Now, when you purchase debt securities on the stock market, the roles are essentially reversed. You are now technically issuing debt to somebody else. They are taking your money, investing in whatever they can, and they will pay you back that money, the amount you lent them, or the principal, with an extra little interest on top. You're typically lending your money to some government or a bank or some other big entity, usually on the federal scale, so that they can raise their capital and invest. Regardless of what the issuer of that debt security does with your money, doesn't matter. Whether or not they lose it, whether or not they make a ton, whether or not they kind of go even, they are going to pay you back a predetermined amount of interest back on your principal. So you can immediately see that this carries much less risk than the equity securities we were talking about before, because you are guaranteed to make that money back. That's why it's called fixed income. Although you are guaranteed to make a return on your investment, these returns are much less than the potential returns that you could get with equity securities. So you can probably start seeing the risk-reward trade-off between the two security types. It becomes clear that on a macro scale, to properly diversify your portfolio, you'll want a certain allocation of both security types within your portfolio. Holding only equity securities, although high potential, carries way too much risk, while holding debt securities poses less risk, however much less reward. Holding debt securities is a strategy typically implemented to hedge against market downturns when equity securities are taking a beating. This happened in 2008 and in mid-March. So you still have that safety net producing a return, essentially just cushioning the blow. The certain allocation between stocks and bonds essentially an investor will change depending on the characteristics I already talked about, such as the time horizon or the age of the investor, their risk tolerance, how much risk they're willing to take, the amount of assets they may have, and their financial goals with their money. Young investors with a longer time horizon are much better suited to take risks on the stock market. It's for this reason that young investors typically favor being heavily invested within equities and lighter on the debts. An older investor with a shorter time horizon, closer to retirement age, will favor more of a mixture of the two just because they are less able to take risks this far into their career. This will guarantee them a return and they can just ride into the sunset. For me personally, my portfolio allocation is roughly around 85% equity securities and about 15% debt securities. This may seem equity heavy, but I'm a relatively young investor, and the equities I am invested in are all large cap companies. They're not very volatile, and I've heavily diversified within my portfolio. For the past, I'd say month, maybe 2 months now, we've been experiencing a crazy bull market right after the bear market in mid-March. And bull markets really do favor equity securities, so I think now is a good time to be kind of positioned into the equity securities. However, for the rest of the year, it's just, who knows what's going to happen, so tread carefully. Okay, so we've got the asset allocation between the two security types. Now we're going to go into a more zoomed micro approach, allocating your assets within each security type. Equity securities can typically be broken down into 11 sectors within the economy, and within each sector are many different industries. To reduce risk and increase your exposure, I've said it before and I'll say it again, diversify. Diversify. You have to diversify. Allocate your equities to many different sectors within the economy, and within those sectors, allocate to different industries. This is going to increase your exposure across the economy and reduce your risk and lower your volatility. This is also implemented to hedge against certain sector downturns. A simple way to diversify is to invest into ETFs, which offer broad market diversification. If you want ETF advice, go back and watch my ETF index fund video. Just toss the link into the description, so go and check that out. Equities can also be further diversified into REITs, or real estate investment trusts, commodities, hedge funds, and individual stocks, encompassing the 11 different sectors of the economy. By doing this, you'll smooth out your return and reduce your volatility. Many investors seeking diversification will also expose themselves to different geographic areas, such as emerging markets and European developed markets. For me personally, these emerging markets hold a very small percentage of my portfolio, as I'm concentrated in large cap Canadian companies. If you are unsure what diversification fits you, either talk to a financial advisor or seek resources online. My sister's boyfriend Dan, shout out, showed me CanadianCouchPotato.com. It's really good for diversification strategies, suiting your own time horizon, your risk tolerance, your assets. It's really cool, so you should check that out. But if you're unsure, talk to a financial advisor. Subscribe to this page. I'll be giving more insight in future videos. I know I hate saying that more than anything in the world. I hate asking for that, but it's unreal. Helps grow the channel, so I'd appreciate that. Just be wary of the current market. We are experiencing bullish patterns right now, which is making no sense at all. But let's just go with it for now and kind of see what happens. But do tread carefully, as I'm not sure why this is happening, and many economists and investors also don't understand truly what's happening right now, why there's such a disconnect between the economy and the stock market. But yeah, just some food for thought like always. Subscribe if you can, stay safe, and I will see you guys next time.